There is a number that most people never think about, and it is this. For every dollar you deposit in your bank account, your bank is only required to keep a tiny fraction of it on hand. The rest gets lent out, invested, repackaged, and sold, often within days of you putting it there. Your local branch with its calm lighting and its friendly tellers is not a vault. It is closer to a casino floor where the house almost never loses, and you are, without realizing it, one of the players supplying the chips. Most people believe a bank is a safe place that simply stores their money until they need it. That belief is comforting, and it is also almost entirely wrong. Banks do not make their fortunes by protecting your cash. They make their fortunes by moving it, multiplying it, and quietly charging you for services you did not know you were paying for. The interest you earn on your savings account, often less than 0.5%, is not generosity. It is bait. Here's what should really catch your attention. A single deposit of $1,000 can, through the mechanics of modern banking, help generate several $1,000s in new loans across the financial system. That is not an exaggeration or a conspiracy theory. It is simply how the machine is built. Your money becomes raw material the moment it lands in their system, and it gets used again and again in ways that were never explained to you when you opened that account. So why does this matter to you personally? Because right now today, your bank is likely making money off you in at least 4 or 5 different ways simultaneously, and you are probably aware of maybe one of them. The free checking account you are proud of is not free. The 0 monthly fee is not a gift. Somewhere in the fine print, in the interest rate gap, in the card swipe fees, in the timing of your transactions, someone is profiting and it is not you. But that's only part of the story. Understanding how banks actually make money is not just an interesting curiosity. It changes how you see every financial decision you make, from where you keep your paycheck, to how you choose a mortgage, to whether you trust the advice your bank gives you about your own money. Most people go their entire lives without ever learning this. Not because it is complicated, but because nobody has ever laid it out for them in plain language. The reason this stays hidden is simple. Banks are one of the few businesses on earth where the customer almost never sees the actual product being sold. When you buy a phone, you know exactly what you are paying for. When you open a bank account, you are handed a debit card and a smile. And the real transaction, the one where your deposits become someone else's loan, happens entirely out of view. The bank has every incentive to keep it that way, because the moment people understand the mechanics, they start asking harder questions. By the end of this video, you will understand exactly how a bank turns your paycheck into profit long before you ever see a cent of interest. You will understand why your credit card charges 20%, while your savings account pays less than 1%. You will understand the hidden fee structures designed to catch you off guard, and the massive, often invisible business banks run that has almost nothing to do with your checking account at all. You will walk away seeing your own bank statement differently. To understand that, we first need to understand the one basic principle that the entire banking industry is built on top of. That principle is called fractional reserve banking, and once you understand it, you can never look at a bank the same way again. Imagine you deposit $1,000 into your account. Common sense tells you that money is sitting there, waiting for you. In reality, the bank is only required to hold back a small portion of it, sometimes as little as 10%, though the exact requirement varies by country and by era. The other 90% does not sit still. It gets lent out almost immediately to someone else, a stranger you will never meet, for a mortgage, a car, or a business loan. Here is where it gets stranger. That stranger takes the loan and spends it maybe on a kitchen renovation. The contractor they pay deposits that money into a different bank account. That second bank now holds a new deposit, and guess what happens next? It keeps a small reserve and lends out the rest again. Your original $1,000 has now helped create a second loan, and that loan will help create a third, and so on, spreading outward like ripples in a pond. This is not theft, and it is not illegal. It is the literal foundation of how modern economies create money and fund growth. Without this system, very few people could ever get a mortgage or start a business, because banks would only be able to lend out exactly what sits in their vaults. But there is a difference between understanding why the system exists and understanding who benefits the most from it, and that difference is where most people stop paying attention. So if your money is constantly being lent out to strangers, working overtime somewhere else in the economy, what exactly are you getting in return for handing it over? That is the question almost nobody asks their bank directly, and it leads us straight into how this entire operation actually turns a profit. The most well-known way banks make money is called the interest spread, and it works almost exactly like a marketplace where you never see the other side of the transaction. Your bank pays you a small interest rate for the privilege of using your deposit. It might be 0.4%, sometimes even less. Meanwhile, it takes that very same pool of deposits and lends it out to a home buyer at a mortgage rate of 6 or 7%. or to a credit card holder at 20% or more. Difference between what the bank pays you and what it charges the borrower is called the net interest margin, and it is the oldest and still one of the largest sources of banking profit in the world. Multiply that gap across millions of customers holding billions of dollars, and you start to see how ordinary interest rate differences become tens of billions of dollars in annual profit for the largest banks. Now here is the part that should genuinely bother you. When interest rates rise across the economy, banks are remarkably fast at raising the rates they charge borrowers. Mortgage rates climb within days. Credit card rates climb almost instantly. But the rate they pay you on your savings account often crawls upward at a fraction of that speed, sometimes taking months to move at all. This pattern even has a name among economists who call it rate stickiness, and it is not an accident. It is simply more profitable to move slowly on what you owe someone, and quickly on what someone owes you. This is why your credit card interest rate has almost nothing to do with what it actually costs the bank to borrow money. It has everything to do with what you, the customer, will tolerate before you stop swiping the card. And interest spread, as large as it is still only one layer of a much deeper system. Because banks have quietly built entire businesses around fees that most customers never fully notice until they add them up. This is the layer of banking that operates almost entirely in silence, and it is the one that drains the average person's finances the most. Precisely because each individual charge feels too small to fight over. Consider the overdraft fee. You spend $6 more than what sits in your account and the bank charges you $35 for covering that gap. If you calculate that as an annualized interest rate on a $6 loan, the number becomes almost absurd, stretching into the thousands of percent. Yet these fees generate billions of dollars industry-wide every single year, and they disproportionately hit people who are already living paycheck to paycheck, the very people who can least afford them. Then there are maintenance fees, quietly charging you $10 or $15 a month simply for keeping an account open, unless you meet a minimum balance requirement or set up a direct deposit. Miss that requirement by a single dollar and you are effectively paying rent on your own savings. Add in ATM fees for using a machine outside your bank's network. Foreign transaction surcharges of 1 to 3% whenever you spend abroad. Late fees, wire fees, and paper statement charges, and you begin to see a pattern. None of these fees are accidental. Account structures are often designed so that triggering a fee is easy, and avoiding one requires just enough attention that many customers slip up anyway. A confusing minimum balance rule generates far more overdrafts than a clear one would, and that is not a flaw in the system. In this business, a small amount of friction is a feature, not a bug, but fees and interest spreads, as significant as they are, still only explain part of where the real money comes from. There is a much larger, much less visible mechanism at work that involves your loan being sold, repackaged, and profited from multiple times over, long after you signed the paperwork. Here is something almost nobody realizes about their own mortgage. When your bank lends you $300,000 to buy a home, it usually has no intention of waiting 30 years to collect that money back through your monthly payments. Instead, it often bundles your mortgage together with thousands of others into a single package and sells that package to investors. This process is called securitization, and it means the bank gets a massive lump sum of cash back almost immediately, cash it can now lend out again to someone else entirely. In other words, your single mortgage becomes raw material for an entirely new loan to a stranger you will never meet. While the bank often continues to service your original loan for a separate fee, collecting your monthly payment and passing most of it along to whoever now technically owns the debt. Count the layers here. There is the original interest spread. There is the fee for originating the loan in the first place. There is the profit made from selling the loan to investors. And there is the ongoing fee for continuing to manage it. One loan, 4 separate profit streams all stacked on top of each other. This same process happens with credit card debt and auto loans, which explains something that might otherwise seem confusing. Why would a bank approve a loan for someone who seems like a genuine credit risk? Because the bank often does not plan to hold that risk for very long. Once the loan is sold downstream to investors, the risk travels with it while the bank has already collected its fees. The incentive to be cautious weakens considerably once the debt becomes someone else's problem. And this brings us to the largest, least understood piece of the entire puzzle, one that has almost nothing to do with your checking account at all. Let's walk through exactly how this looks with real numbers, because the abstract version of this story is easy to nod along to, but the specific version is where it actually clicks. Imagine a bank holds $100 million in customer deposits. Regulatory requirements might allow it to keep only $10 million of that in reserve, meaning $90 million becomes available to lend out. That $90 million lent primarily as mortgages averaging 6% interest, generates roughly $5.4 million a year in interest income, while the bank might be paying its depositors an average of only 0.5%, costing it around $500,000. The spread alone nets the bank almost $5 million annually from deposits that customers assumed were simply sitting safely in an account. Now layer in fees. If even 10% of that customer base incurs an average of one overdraft fee a year, at $35 each, across a large enough customer pool, that alone adds hundreds of thousands of dollars in pure profit, with almost no additional cost to the bank beyond the software that flags the transaction. Add mortgage origination fees, often 1 to 2% of the loan amount charged up front, and on $90 million in mortgages issued, that could mean another $900,000 to $1.8 million collected the moment the loans are signed, before a single mortgage payment has even been made. This is not a hypothetical exaggeration. This is roughly how the math works out at scale, and it explains why banks remain among the most consistently profitable industries in the modern economy, year after year, regardless of what is happening in the broader stock market. Given numbers like these, it is worth asking why so many people still misunderstand how their own bank operates. And the honest answer involves a handful of very common and very costly mistakes. The first mistake is assuming a checking account with no monthly fee is genuinely free. As we have already seen, the bank recovers that cost elsewhere, through interest spread, through interchange fees charged to merchants every time you swipe your card, and through the simple fact that your idle deposit is quietly funding loans elsewhere. Nothing about a bank is charitable, even when nothing appears on your statement. The second mistake is treating your savings account interest rate as competitive, without ever comparing it to what is actually available elsewhere. Many people leave tens of thousands of dollars sitting in an account paying near 0%, simply because switching feels like a hassle, while other institutions offer rates many times higher for holding the exact same cash with the exact same protections. The third mistake is not reading how minimum balance requirements and fee triggers actually work, assuming that a bank's marketing materials reflect the full picture. Full picture is almost always in a much longer disclosure document that very few customers ever open. And the fourth mistake, perhaps the most costly, is assuming that because a bank approved you for a loan, that loan must be a good deal for you personally. Approval only means the bank has calculated that lending to you, and likely reselling that debt, is profitable for them. It says very little about whether the terms are actually in your best interest. Knowing these mistakes is useful, but the real value comes from understanding what people who manage their finances well tend to do differently once they see through the illusion. People who navigate the banking system most effectively tend to treat their bank the way they would treat any other business, trying to sell them something, with healthy skepticism, rather than blind trust. They compare savings rates across institutions the same way they would compare prices before buying a television, because a difference of even 2 or 3 percentage points, compounded over years on a meaningful balance, adds up to real money. They read the fee schedule before opening an account, specifically looking for what triggers an overdraft charge and what the minimum balance requirement actually is, rather than assuming the friendly branch representative has already told them everything that matters. They understand that a bank's core incentive is to maximize profit from their deposits and their borrowing, not to optimize their personal financial well-being, and they make decisions accordingly, using the bank as a tool, rather than treating it as an advisor with their best interests at heart. Perhaps most importantly, they understand that keeping large amounts of cash sitting idle in a low-interest checking account is itself a decision, and with a real cost attached, even though no fee ever appears on the statement to remind them of it. All of this leads to a single, larger realization that ties every piece of this story together. Banking at its core is not really a business built around protecting your money. It is a business built around borrowing your trust and then monetizing it through spreads, fees, resold debt, and financial products that operate largely out of sight. None of this makes banks villains in any simple sense. Lending is genuinely necessary for a functioning economy, and without it, most people could never buy a home, start a business, or smooth out the uneven timing of income and expenses across a lifetime. But there is an enormous difference between a system being necessary and a system being transparent. Banking has historically leaned hard toward the former, while doing very little to encourage the latter. The information you now have was never actually hidden from you. It was always sitting in disclosure documents, rate sheets, and fine print. It simply required more effort to find than most people were ever willing to spend. And the entire structure of the industry benefits from that gap in effort. You now understand what that marble floor and that friendly smile at the counter are actually built on top of. Your paycheck. working overtime in ways you were never quite invited to see, generating profit through channels that were never fully explained to you, layered one on top of another until a single deposit becomes a machine that runs almost entirely on its own. That knowledge does not require you to distrust every financial institution, but it should change how closely you read the fine print the next time you sign something. If you enjoyed this video, subscribe for more videos about money, investing, economics, business, and wealth building.